As we always do, this is looking at the U.S. hot roll coil price relative to European in blue and Chinese pricing in orange. And really, for the last couple of months, both Europe and China have been fairly subdued and pretty downtrodden with regards to their price levels, down at 505 and 650. U.S. prices very much so not cooperating or not following the same trajectory. We, over the last couple of months, have seen domestic prices go from, depending on what index you use, 650 all the way to, let's call it 1050. So $400 move in the last 2 to 3 months. Pretty staggering move. You would think that would be surrounding a very big demand push, something booming in the economy. And I would say, at least in my opinion, that's not exactly what we're seeing. I would attribute a lot of this to a couple things. One is capacity utilization has been pretty subdued. I think some of that was purposeful. I think some of that's due to outages, maintenance, things like that is taking place over the last couple of months. Utilization rates are down at 74%, which is a pretty low number. So domestic mills are trying to keep a better balance in supply-demand conditions. Imports were fairly low for the last several months, at least up until about September, October. So that also helped to keep markets a little tighter than they otherwise would have been. And then I do think we saw a fairly large amount of domestic stockpiling or bottom fishing, however you want to word it, where domestic buyers of steel, those who have the capital to do so, went out and bought 5,000, 10,000, 20,000, maybe 50,000 tons of carbon sheet. And what that can do is it artificially, I usually use the word artificially, it is real, but it pushes out lead times to a very extended point. And I think when that happens, you get this perfect storm of domestic mills say, it's time to hike. It's hard to get metal right now. Let's take prices as high as we can. And that seems to be what they're doing. And I'm not trying to paint them in a bad light. I think that is a very, financially focused ideal. And a lot of these companies are publicly traded and they're allowed to do so with their prerogative and balance supply demand conditions. Do I think it's supported by the cost structure? No. If we look at power prices, natural gas prices, we look at scrap. If we take scrap prices for an electric arc furnace and we add on 250, we get this yellow line here, which basically says that the cost structure or the relative fair value of steel is somewhere right around $800 for hot roll. So if it's $800 for hot roll, maybe it's $1,000 for cold rolled. Well, the current price on domestic steel in the spot market is somewhere in the realm of $1,050 to $1,100. The futures market similarly is up around $1,100, at least for the next couple months. I wouldn't say any of this is supported by any, you may talk to a mill and they may say, well, scrap's gone up. Well, scrap hasn't gone up $400. They have an opportunity to make hay when they can, and I think they're certainly doing so. And if this feels familiar, it certainly should. This is the futures curve as of right now, or this week rather. So what we've got here on the futures curve is the peaking out somewhere in January 2024, at least if we took a snapshot as of today. That could change. If we get another round of price hikes, this could move higher and maybe it extends out into the future. But as we sit here today, the peak per the market's forecasting is January 2024. This curve looks an awfully like about 250 days ago when we saw prices dramatically run up. It was a situation where it was a very similar phenomenon. You couldn't get imports. You could barely access the spot market. If you wanted to access the spot market, it was name your price. And we saw that phenomenon take place over a couple months, and things peaked out in April 2023. So I don't want to say I'm predicting the future, but I would say that the setup for the steel industry looks eerily similar to what we saw in Q1, which transpired until the beginning of Q2. And then we saw things just kind of roll a bit lower as we rolled through the course of 2023. Already we're seeing this repeat. It's just kind of shifted back a couple months in terms of where the peak is being forecasted. So I thought that was a fairly interesting thing. The curves, you can tell where they bottom on the back end and where they peak on the front end, they're almost identical. And unfortunately, I personally just don't see, I think demand is fine. I think the end markets are mostly fine for steel, but I don't think there's anything that suggests that we should be seeing 90% volatility over the course of 3 or 4 months, or prices going higher by that amount over that period of time. So my gut is it may not look exactly like this futures market, but this could be something that's somewhat short-lived, unless we see something change in the demand side of the equation.
And
On the aluminum side, yeah.
sorry, before you get in there, Mark, maybe this is the best question for you. There's been a fairly significant amount of price increases announced from the mills in September too, right? Do we think that's going to continue into the new year?
It could. Nick put everything, pretty much like, I would have said it as well. Yeah, I mean, we've seen a rash of increases, that started at the end of September, and they've all made their way into the market. So yeah, I mean, could we see some more? It's possible. I think, once you get some, some scrap data that comes out, give the mills any kind of, reason or rationale to do it again. Yeah, I think it's certainly possible that you could see that.